Well, stocks are set to open at all-time highs after the S&P 500 closed above 5,500 for the first time in history. But taking a look at the futures right now, we are seeing the market pairing those gains that we saw earlier in the day off of some of the data that is coming out. We're also seeing moves in the Treasury space. So we're going to discuss all of that and more with our next guest, who does see more upside to come. Joining us in studio, we've got Elyse Ausenbaugh. Elyse, thank you so much for joining us. I should mention you're with JPMorgan Wealth Management and a global investment strategist there. So talk to me about the data we got this morning, because we are seeing treasuries falling a little bit off of it. How big of an impact do you think that this could have?
I think the bigger picture is the primary driver of the story, right? We too are going to be hyper-focused on what we see out of the employment data come Friday. But all in all, we continue to see a labor market that remains rather robust and working in the favor of consumers with positive real wage growth. And I think we're finding ourselves in kind of this healthy slowdown that ultimately gives one of those key ingredients for the soft landing.
And so how long would that slowdown kind of, if it does continue for too long, at what point does it become an unhealthy slowdown?
Mm-hmm. Yeah, the thing about labor market moves is they can happen really, really quickly, but you're not seeing that dramatic deterioration in things like unemployment yet. I think if you were to see a meaningful rise in the unemployment rate above 4%, that would maybe start to stoke some concern and maybe put that Fed put back on the table. But for now, I think all things considered, we remain confident about this rebalancing of labor supply and demand.
How does that play into your take on the equity market, given that we have hit these recent all-time highs, but there is this constant question about valuations and concentration?
We're actually pretty comfortable with valuations where they are right now. I think in an absolute sense, you of course can point to something like PE ratios and say, oh my gosh, relative to history, they are elevated. And particularly when you're comparing that to where bond yields are right now, I think it causes some pause for investors. But in an environment where inflation concerns and risks are perhaps as great as recession risks, neither of which we think are particularly meaningful, our base case is for a soft landing. I think so long as that remains part of the equation, these valuations are actually fairly justifiable, particularly because the rally is being driven by these really profitable companies that are surprising to the upside.
Right, and it was a larger question for investors out there trying to figure out or wrap their minds around whether or not we could continue to see new all-time highs if we did not see the Fed signaling that they were ready to cut here. But for Fed Chair Jay Powell, who's coming out in Portugal yesterday, of all places, won't even say this on our home soil, coming out in Portugal and saying, hey, we need to see more evidence. Is the more evidence just the amount of data, or is it more deterioration?
I think it is a continuation of the trend that's resumed in the second quarter of this year. What we've seen from the inflation data in recent releases suggests that maybe the Q1 sort of hot streak was more of a blip on the radar. So I think what Powell and the rest of the FOMC are really looking for is just this ongoing cool down. But with PCE at 2.6%, when you're looking at that core measure, I think that is a rate of inflation that corporate America is rather comfortable with, and you're seeing that show up in, resilient profit margins and ongoing rolling recoveries in earnings.
Speaking of those rolling recoveries in earnings, though, I am curious the degree to which earnings are going to drive the market heading into the next couple of months here, or is it going to be politics or the Fed? Which of those three do you think defines the next, let's say, 6 months?
Sure. So in the near term, I think with all of the uncertainty that's kind of rearing its ugly head related to the elections, that very well could stoke more volatility. I think as investors continue to play this guessing game of not if, but when the Fed will cut interest rates, that might cause some fluctuations in markets. But at the end of the day, we think that the next big catalyst for equities is going to be the earnings season. And when we pencil in our outlook for the year ahead, it's really that earnings component and not the valuations that's driving our outlook for the S&P 500 to hit more all-time highs over the next 12 months.
With earnings season being the catalyst, what do you think that the theme that prevails this earnings season is?
Look, in Q1, we saw a lot of focus and mentions of things like artificial intelligence. So investors should probably continue to be really focused on not just whether those companies are talking about it and thinking about incorporating it into their business models, but whether they're actually applying it in real time. That adoption will, be a process measured in years, but nonetheless, we do think that it's going to continue to offer tailwinds for the enablers, but also start to cause some beneficiaries in terms of productivity increases or cost efficiencies to emerge across sectors.
Elyse, thank you so much. It's always great to have your insights. Really appreciate you coming in studio. Thank you.
Thank you.